Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate with your host, Kevin Perenio. As an owner and C-level executive for 20 plus years in finance, KP is here to serve you with all of his knowledge and experience. Whether you're a broker, realtor, or just interested in the economy, this is the podcast for you. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Corona, California. Well, it was neither a swift ending, and it is the end of swift for the Putin campaign that's going on in Ukraine. I'll get to that in a moment, how it impacts interest rates and inflation, oil, and other commodities that affect our economy, and of course, housing and our industry. Before we get into that, just want to send our thoughts and prayers out to the family of Megan Heath. It was announced today by NAMBA, which is the National Association of Minority Mortgage Bankers of America, founded by Tony Thompson. Megan Heath used to work for them, and unfortunately she passed away in February. And there was a press release that went out today from NAMBA. I'm friends with Megan. She was a Chief Development Officer. Had a chance to work with her at every NAMBA Connect event. And she just worked her heart out, for NAMBA and the mission to try and get people intentionally in our industry that may not know about our industry. And I'll never forget at the Mortgage Banker Association meeting in Austin about a little over 2 years ago, there was an early meeting that NAMBA put on where they had students bust in from all around Central Texas and Austin, and Megan helped shepherd that entire process. And these students came in and watched multiple people speak. Bob Brooksmith, Sue Woodard, Tony Thompson, myself, talking about college students and how to get them intentionally into our industry and think about housing. Because, it's not something that people think about in college, and that's part of the mission of NAMBA. Megan was on the front line doing that, and may she rest in peace. And let that be a reminder that life is fragile. Whether it's a dear colleague like Megan working for a great organization like NAMBA, and unfortunately leaving behind a husband and 2 sons, or it's a coworker battling cancer. It's, the gentleman that I speak to every night who, takes out the trash for our building, gave him a slice of pizza and a bottle of water, or it's the people in Ukraine that are suffering an invasion from a tyrant like Vladimir Putin. It's just a reminder that it's time to be a good human being now more than ever, as winter comes to an end, and it will come to an end, just like this pandemic is coming to an end. This fight on this virus seems to be ending. Even states like New York are lifting their mask mandates, and now the state, California, that I live in for the last 6 years, are also going to get rid of their mask mandates. Mama Bear is happy with the 4 kids in school not having to wear masks as of the 12th. And even the CDC released some guidance. So things are fragile in life in this world, but there's still positive news out there that we can all grasp onto. So let's talk about Ukraine and what happened today. So I believe the strategy by Putin was to kill the head of the snake, as it is called. If he can get in there and take over Kiev, the capital, take down Kharkiv, which is the second largest city, and can end it swiftly, get Zelensky to surrender, or get people to surrender, or whatever his motive, that he would be able to take over Ukraine. And unfortunately, it's not working for him. And the longer it drags on, the more uncertainty there is in his own economy. But then, of course, the uncertainty of how that will impact us here at home. The way the bond market reacts to a geopolitical event is that there's a flight to safety. So a lot of investors around the world, they pour trillions of dollars into safe assets like mortgage-backed securities, which impacts our interest rates. You saw interest rates improve today, a pretty good amount. You also see U.S. treasuries being bought. The U.S. dollar is the reserve currency of the world. It is a safe haven for assets. And when the SWIFT banking system was cut off to Russia, that had this impact on the market today, and it impacted Russia specifically. So the Society for Worldwide Interbank Telecommunications, the Society for Worldwide Interbank Financial Telecommunications, or SWIFT, was cut off. So basically, it's like Twitter for banks. They send messages, hey, here, we're going to send you this. Here's the order. Send us some money here. And it's a big deal, the fact that Russia's cut off from SWIFT. Remember, the first letter in that acronym is society. They have been banned from this society. They were in the society. These Russian banks are banned from this society, SWIFT. They are not allowed to send communications to get wires out. And that will hurt their economy. The ruble, which is their denomination of currency, fell 30% today, yesterday, it's after midnight, and 40% month to date in the month of February. So that's a big deal. Now, when this happened to Iran in, I believe, 2012, when they were trying to pursue nuclear weapons, 50% of their oil revenue was lost when they were banned from the SWIFT system. Think about that. 50% of their oil revenue, 30% of all exports for that nation in Iran went away, and that economy went into a deep recession. There is a run on the bank right now, run on multiple banks. There are several banks that are being targeted with other sanctions within Russia, and of course, personally, Vladimir Putin. So what now? What, right? I'm not into doom scrolling, as they call it. You're looking around for the videos and the war-torn stuff. I mean, I've seen enough of this in my brief 45 years on this planet to know that the suffering is, it's not fun to watch. And I hate to think how desensitized I was in my 20s to death and 30s. And now I feel so empathetic about the people that are suffering. And it will have an impact, these measures, these sanctions. They're going to hurt countries that need the oil and the natural gas from Russia, who's such a massive supplier of these things. It will impact us. It will impact inflation, which is the bigger issue that we are facing as a nation that is impacting our economy and slowing our growth. We are an interconnected global economy, a society, if you will. And like it or not, Russia is part of that society. They're part of the UN Security Council. They are a major global force as it relates at least to oil and gas. And so there will be repercussions. But for now, the flight to safety has created lower interest rates. And for housing, that's a good thing. It helps with affordability. Will it be something that lasts for a while, or will that be a start of a trend? We saw the 10-year touch around 2% and kind of hover around there for a couple trading sessions. It came down to like 182 or 184 today. So this trend of slowing growth, will the U.S. economy go into a recession? Obviously, the Russian economy is going into potentially a recession imminently. I read by Paul Molo here and Inside Mortgage Finance. He said that the Russian central bank equivalent raised their federal funds rate today 1,100 basis points to 20%. A 20% Fed funds rate. I mean, we're arguing about in 2 weeks, are we going to see a 50 basis point rate hike or 25 basis point? I've always thought it'd be 25. I certainly thought it was going to be 25 after this Ukrainian invasion by Russia. And I mentioned that on my last podcast. Russia, according to Elliot Eisenberg, the Bowtie economist, Russia currently produces 10 million barrels of oil a day, about 10% of the world production, making it the world's third largest producer and second largest exporter. Imagine what the SWIFT will do to them, the run on the bank, the recession they may be going into in their economy with these sanctions. You've got to give the Biden administration some credit. He got a coalition to come together with the European Union, with Australia, Japan, and other countries around the world, the society, if you will, and said, we will not stand for this aggression, man. This aggression will not stand. This is not how you run a country in 2022. You can't just go across borders because you're pissed off because you want to be Ivan the Terrible. It's not going to work, and it's nice to see everyone stand up to that. So according to Elliot Eisenberg, every $10 rise in the price of a barrel of oil could temporarily raise inflation by about 0.2% and reduce GDP by about 0.1%. That's a big deal. It's a real big deal. So what else is a big deal? We got the jobs report coming out Friday. We also have ADP report, and the Fed is speaking the next couple of days on the Hill in front of the Senate Banking Committee. So lots going on. There will be more certainty with more of this data coming out, and we'll see. Are we going into a recession here at home? Certainly Russia seems like it's going into with the sanctions that are occurring. We'll get back to you. Had a lot more to talk about, but apologize. First day back in a long time. So we'll get back to you in a couple of nights. Cheers. Hey, it's KP coming to you live from Corona, California. Well, it's my last update for the week, and then we're off to the races here. I'll be off-site traveling each of the next 3 weeks. We've got the Lenders One conference in Phoenix, and then the ICE experience in Las Vegas the week after that, and the Mortgage Collaborative in Miami. So here we go again. Time to hit the road. Had a great podcast yesterday with Audrey Boisano and Kevin Casey for the California Association of Mortgage Professionals. They like to have an awesome podcast every Tuesday. Definitely encourage everyone to listen. And we had a healthy discussion about some things I'll be talking about today. So we're going to talk about velocity of money. We're going to talk about liquidity versus static capital. And we're going to talk about the Fed, a little bit about Russia and Ukraine. And nobody wants to talk about the pandemic, but seems to be over. But we won't get into that until we get someone to officially come spike the football out there. But sure, it's nice to see mask mandates and even the CDC put out guidance. So hopefully we can get out of this thing that 2 years ago this week was pretty much crushing us. We were talking about maybe having lockdowns and margin calls were going nuts. I was just coming back from Mardi Gras where I caught COVID and everyone was getting sick there in New Orleans after being there for 5 days for 2 trade shows. But let's not talk about that. Let's just move forward. Let's talk about what's going on. So remember, the bond traders are supposed to be the smartest guys on Wall Street. They know what's going on. They're very in tune with the markets, and they're not very skittish and jumpy. They know what's going on, but they are having a hard time reading the tea leaves because of so much uncertainty. Just in the last 4 trading sessions, if we were to look at the 10-year Treasury, which is a pretty good barometer of what's going on in our economy and certainly impacts mortgage interest rates. We've been, 4 trading sessions, we were over 2% or touched over 2% on the yield, and then came down, into the 170s, and then back into the 180s, and now back into the 190s, just in 4 trading sessions. A lot of movement going on there. So what's all the uncertainty? Well, obviously we had the Russian invasion of Ukraine, which created a flight to safety. People didn't want to lose their money because they didn't know what was going to happen when a nuclear power is on the warpath. And you saw a lot of people buying treasuries, which of course brought that yield down, which made our interest rates really great. The last 2 days have been great. I'm sure you've noticed, those of you locking your loans and locking your pipelines, the first 2 days of March have been absolutely incredible. Just like 2 years ago, the first week of March, as the pandemic was starting, we took in $1 billion in locks here, whereas the entire month of February, we took in $1 billion in the month of 2020. And that's when I started getting the camera out here and showing you the good candlestick charts from MBS Highway, and you can still check those out every day. But then now with some certainty about, okay, well, maybe Ukraine isn't going to topple so quickly, and maybe it's not as crazy as we thought it was going to be. Of course, that's a little uncertain. And then the Fed spoke. The Fed spoke today, and they came out and said, hey, you know what? We're going to be pretty methodical about how we're going to operate here, and 25 basis point hike is what we're planning on implementing at their meeting that's coming up in just a couple weeks. And they said a 50 basis point rate hike is not out of the question if inflation remains high and persistent. So then, of course, the bond market moved again today. So what's going on? Why is all this schizophrenic market action happening, and why are our rate sheets going up and down? Our rates are getting better, then they're getting worse. It's hard to handle, right? But again, there's a lot of uncertainty. And so when we talk about data, which is the math, science, facts, and data that comes out to give us more clues and bring more certainty, we have to just continually look at how the economy is doing. Our GDP, our gross domestic product, is made up mostly of consumer spending. 70% of our GDP is made up of consumer spending. So what's going on with the consumers? How are they feeling? Well, one thing that can obviously help them spend is if they have a job. And we know we've had record job openings, and the ADP payroll report came out today, and it's interesting. There were 75,000 more jobs created than expected for 475,000 jobs in the month of February, as opposed to the 400,000 expected. But the surprise really was an upward revision from the last report that had a negative 300,000 reading, and then upward revision to 500,000 net new jobs. That's an 800,000 job swing on past reports, plus the 475,000 that came out for this past month. So are we back? Are we creating jobs? We're going to find out Friday, again, when some more data comes out, when the February Bureau of Labor Statistics jobs report, the monthly jobs report, the big payroll report. My guess is there'll be some upward revisions as well. Remember, that's the second half of January and the first half of February reports for the February job report, payroll report. And there could be some data that's trickling in from prior reports that sees upward revisions. Now, I read in the Chrisman blog today, at the very end, I love the section that Robbie Chrisman puts together in the cap markets. He was talking about the manufacturing index continues to show expansion in manufacturing, and construction spending was up in the month of January. And those are good signs for the economy. So my guess is probably what we'll see in this jobs report Friday is we'll see a pretty decent increase in manufacturing and construction jobs. Will there be service or hospitality jobs? My guess is yes, even though we were still kind of dealing with the Omicron variant. Every state dealt with it differently. So we've got multiple states that have lifted their mask mandates many months ago, and some of them have just started to finally lift that, like I mentioned the other night on the podcast. So what's going on with Russia? Let's talk about Russia for a hot second here and how it impacts our economy. We don't exactly know what the ripple effect will be of all the sanctions and what their next move will be from an economic standpoint. Clearly, there's a cyber war going on as one of the reactions of the Putin administration. They raised their version of their Fed funds rate was raised 1,100 basis points, 20%. So their Fed funds rate, if you will, in Russia is 20% to try and stave off their massive hyperinflation. Now their ruble is worth 50% less compared to the dollar, which is strong. In the last month. So lots going on there. How will it impact things like fertilizer and food and commodity and oil prices? Oil is topping 110 a barrel, and that will hurt people here at home. When it comes to paying for heating, paying for gas. So we'll have to look and see what the long-term effects will be. The Fed has said that they are highly uncertain. That was the quote that Jerome Powell gave today of what the impact will be with the Russian invasion. So that's something to keep an eye on, because if he's uncertain, he's saying that, we don't know. Obviously, they've got more data than anybody. So we'll see what goes on there. So, so what does it all mean for us? What are we talking about here when we're talking about velocity of money and the Fed funds rate? So I'll kind of tie that in. The FHFA, which is the regulator of Fannie and Freddie, is reproposing some capital requirements, and they're basically saying that lenders need to set aside a certain amount of money. Now, what's interesting is Chris Whalen, at the Institutional Analyst, wrote in the comment period to the FHFA and basically said, there's a real big difference between static capital sitting on the sidelines and being saved and being hoarded versus liquidity. It's liquidity that we need in the system. When the market froze up 2 years ago, it's because people weren't buying mortgage-backed securities. They didn't know how much money they needed. They had to hoard their money to pay for taxes and insurance, or potentially pay for borrowers going to default that were losing their job and couldn't make their payments because of a bat soup virus-induced pandemic. And so when money is set aside, when businesses save, when businesses hoard, when businesses feel like the taxes are going to be raised and they have to set money aside, or capital requirements are raised, that's less money exchanging hands, and thus there's less velocity. And that's not good for the economy. That brings down our gross domestic product. Consumers can also impact that. If consumers feel like prices are too high because of inflation, well, they can just spend less and they can save their money. They maybe won't take that trip. They won't fly somewhere. They won't get in a car and pay high $5 a gallon gas prices. And the velocity of money slows down, and so does our economy. And that's how you end up sometimes in a recession. So there's a lot going on here. I think about velocity of money. I think about liquidity and how we need to keep things going, keep dollars exchanging hands so we can keep the music going. Housing is still very strong, and that is a bullish, robust sign for us. I'll catch you next week from the road. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.